Mr. Subramaniam, for joining in. Always a pleasure catching up with you. What is the status at this point of time, for the markets? I mean, one thing is for sure, we have significantly been underperforming the rest of the world, especially in the last 8 to 9 odd days. What do you think is concerning the markets? I mean, is it the whole geopolitical situation, especially with the incident that has happened, that has put pressure on the Indian markets at this point? Because, yeah, we don't know, we have the general elections coming up, the budget has gone behind us. So what do you think has been the key reason for our underperformance?
I think that the FIIs are being wary about investing in India right now without getting much clarity on the domestic political situation. That is one. And the US-China talks do have some implications for the Indian economy in terms of exports and our Make in India program. So probably a period of wait and watch. I would say nothing more, nothing alarming. Just that at this point in time, committing fresh capital, it's probably something that they would rather wait for a little bit before they do. Domestic fund managers are also being cautious at this point of time because of the election. So I would say it's a combination of lack of liquidity which is driving this issue in the Indian markets rather than any fundamentally something wrong with the Indian economy or anything else.
Okay, all right. So you do expect the markets to move more or less sideways. So I suppose then, Mr. Subramaniam, it would be more advisable or more prudent to just look at it from a more stock-specific approach then?
Not necessarily. I would say that if you generally put your weight behind large caps from if you have a perspective of say a year to 2-year outlook, if you put your faith behind the large cap basket, I don't think you can go wrong. You will probably end up with a high single digit, low double digit kind of a return. So I'm not sure that you should continue your asset allocation and keep investing. I would say from an investor perspective, into large cap oriented mutual funds, probably 65% towards large caps from a 1 to 2 year perspective. So I wouldn't say that it's a time to stay away or anything, because when there is volatility, uncertainty, and as you said, our market is underperforming, from a longer term it's probably the right time to invest, right? So you shouldn't take a decision of not doing so. Fund managers will take their tactical calls, but I think from a broader investor perspective, I think he should continue to do his allocation, like I said, 60-65% towards large caps at this point in time.
Okay, Mr. Subramaniam, so is mid-caps a no-go area currently? If you see, the broader markets have been outperforming the benchmarks for the last 4 days. So would you advise that you can look at the broader markets right now, or just stay focused only in large caps?
So for me, there are two types of investors who can look at mid-caps. So one is a clear perspective of 3 to 5 years in their outlook, if they're not worried about the money. Second is who are prepared to take intermittent volatility, because I would say that mid-caps will continue to reflect volatility because 2 or 3 of the large segments within the mid-cap pack, right? I think IT is a little bit high on valuations. Cap cycle, the valuations looking high because the earnings growth or the order book growth hasn't been as strong because private cap is yet to pick up. And in corporate banks, the coming out of the NPA cycle, especially public sector banks, which are a large part of the mid and small cap space itself, I would say that at this point the volatility for some more months is likely to be there. So if you are really worried about short-term intermittent volatility, that's when I would say. But if you have a 3 to 5 year perspective and you're a person who understands equity market volatility, then your allocation to mid and small should continue, because these are probably the best months from where your future returns are going to come.
Okay, fair point. Now, Mr. Subramaniam, I was looking at some of your top sectors, consumption. You can't help me wondering as to whether or not the valuations perturb you, or do you believe that with the recent crack that we've witnessed, perhaps valuations may have come at a relatively comfortable zone now?
See, if you look at it, we expect that there would be about 8 to 9% volume growth, right? And we expect that prices should still be under a little bit of pressure, so maybe 1% price growth. So we would say 9 to 10% volume growth. But reason we are also continuing to remain bullish, because the headwinds of last year on the earnings, right? This is what I spoke about top line. On the earnings, last year's headwinds came on the back of higher crude, right? And on higher dollar, a weaker rupee. These two, in the consumption space, those input costs are very high. This year, on the back of those last year's high costs, on the higher base of those costs, we expect consumption companies to actually benefit from an EPS growth expectation perspective. So we believe that the current valuations, with the correction, with the easing of crude pressures, the price pressures on their input costs, should actually turn out that those valuations are fairly reasonable, and hence we continue to place our bets on the consumption sector in a differentiated way.
Speak about higher input costs. Do you believe that, FMCG at this point of time is in a position that where they have more pricing power, where they are more comfortable passing on these costs to consumers?
Like I said, 1 to 2%, not too much. But yes,
okay.
1 to 2%.
Okay, all right, fair enough. Let's talk about the other space you mentioned, IT. It certainly has been the flavor of the last couple of months. We've seen a lot of activity come by over there. What makes you bullish on an IT space?
We're not bullish. We consider it a part of the safety portfolio because we believe that IT companies' business models and growth are fairly strong. But the last year that what we saw, the valuations rose up because there was a strong headwind of weaker rupee helping IT companies to post better returns. That strong positive headwind is not there this year. So I wouldn't actually put it that we are very bullish. What I would say is that a safety component of a portfolio, we see that the visibility in the earnings and the valuations are more or less in tune with each other, and hence the lack of negative surprises from this sector would mean that there would be a significant allocation to that in order to protect your portfolio from volatility. So it is a key component, probably in and around the benchmark weightages that we will keep in order to protect our portfolio from the volatility aspect. So that's the correct view that we would say on IT, and more in the large cap space, because the smaller cap space, as you saw, I think valuations did rise up a lot, so there we are a little more cautious.
Okay, all right. So not exactly bullish, but yeah, large cap IT essentially is like a safety net for perhaps that, Mr. Subramaniam is recommending that you may keep in your portfolio. Thanks so much then for joining in, giving us an overall sense of what exactly is happening with the markets and of course some individual sectors as well that Mr. Subramaniam has flagged of consumption and IT. Well,